Hello, everyone. Welcome to this virtual learning environment. So basically what I'm going to be doing is a recording of the PowerPoint along with me talking through it just as if you were in class normally. Okay, so I'm just letting you know I did have surgery recently, so my throat's a little sore. So please just bear with me with all this, but I'm not sick or anything, and I hope all of you are doing well as well. So what I recommend doing is following along when I do this. So online in under module chapter 17, you have all the information you need. You have this video. Um, you have the actual PowerPoint if you want to just, look through the PowerPoint without me talking through it. You have the notes page, which is has a list of all the formulas that we're going to be going over, so that's very helpful. And then the classwork problems. So basically, as we go through the PowerPoint, I'll be working on the classwork problems for this, so you should really have this open and kind of follow along to make sure you're understanding on how to do this, and then the answers are also posted as well. So even though I'll be going over the answers in the PowerPoint, it might be helpful for you to also have that up and to take a look at that. Okay, so let's begin. So this is the Chapter 17 PowerPoint. We're going to be going over the analysis of financial statements. Here's the agenda. We're going to be going over just some basic information and overview of what all this is for. And then the three main points, which is the horizontal analysis, the vertical analysis, and the ratio analysis. So these are the three main topics that we're going to be covering. And they're pretty easy. I'd say this chapter is a lot easier than the other ones we've done prior. There is a lot of math in this one, but it's all adding, subtracting, multiplication, division. There's no algebra, no statistics, no calculus, nothing like that. So it should be fine for all of you to do this. Okay, so we're just going to go over some basic points of doing an analysis. So it helps us to make better decisions. So we're going to be just doing some math problems to see certain numbers, how a company's been doing. Are they doing better or worse than last year? How are they doing compared to other companies? So it'll help us make better decisions if we want to maybe invest in these companies. Okay, helps reduce uncertainty. So, gives, instead of just guessing, oh, I think this company is good, we do have hard facts on how they've been doing. We're going to be using the an analytical tools. So like I said before, it's the horizontal, vertical, and ratio analysis that we're going to be doing. And it involves transforming data. So we're basically taking information from the income statement, from the balance sheet, and transforming that into specific numbers. And those numbers will tell us how a company is doing. All right, here's the building blocks of analysis. So we're going to be going over this mostly when we're doing the ratio analysis. We'll be going over the liquidity and efficiency numbers, solvency, profitability, and market prospects. So I'll go over all of this when we get to the ratio analysis. Okay, so here's the three tools we're going to be doing. I stated this already. It's a horizontal, vertical, and ratio analysis. Those are the three main points. Let me move this out of the way. Okay, so you can compare information all within the same company, but you can also do it on an intercompany basis, meaning like think intercompany, like interstate, connecting two states. So we can look at, company A compared to company B and see which one is doing better. More specifically, you can do it based on competitors. So that's like your stock market project that you have to be doing. You're doing competitors, like McDonald's and Burger King or AT&T and Verizon. So you're going to be doing a lot of these analysis based on your companies and comparing them competitively. Okay, you can do it like on an industry analysis. So basically, overall, for everyone in the cell phone industry, what does this number usually need to be in order to mean that the company is doing well or not? Or anything in the fast food industry or the hotel industry. So you don't have to compare them between specific companies. You can do an overall analysis or just general guidelines. So usually a number over 1 would be something that means the company is doing okay. If it's below 1, then maybe it's not doing so well. So you could just look at general guidelines, but the more specific you are, usually the better information you're gathering from this and the better decisions you can make. Okay, so we're going to start by going over the horizontal analysis. This is very easy to do. Okay, so we're going to be looking at how a company is doing across time, like last year compared to this year, or over the last 5 years, how are they doing? Are they doing better? Are they doing worse? What's going on? And we always want to see that a company is improving. So it's pretty easy to do this. We're just going to look at how much, each line, each account has changed from last year or prior years until now. And we do this by taking the current period amount minus the prior period amount. And that all shows how much it changed. So let's say if this year my net income was 120,000 and last year it was 100,000, that means it went up by 20,000 this year. Okay, so we want to get two numbers here. One is the dollar change, how much has it changed in dollars from last year to this year? And then we also want to put this onto a percent basis. Okay, so we want to put this on a percent basis by taking the answer we just got, the dollar change, how much it's changed from last year to this year, and divide it by the prior period amount. So basically the oldest amount you have on there, and then multiply it by 100 because you do want to turn this into a percent. So this is really easy to do. So if you open up your classwork, we're going to go over the chapter 17 classwork, problem number 1. So you can just follow along with me as we do this. Okay, so to do this, it's really easy. So remember, it goes in kind of like backwards order where it starts with the newest year and then goes to the oldest year. So we want to find the dollar change and the percent change. So this is, not a full balance sheet, just a couple lines just to give you the idea of how to do this. So basically, you want to take the newest year minus the oldest year. When you subtract, that will give you the dollar change. So I have my phone out as a calculator, so kind of just follow along as we do this. You can also do it and then pause it and see what the answer is. So 374,634 minus 234,000. I got 140,634. Sorry, I'm using the trackpad on here, so the writing is not so fluid, so just bear with me in the horrible handwriting up here. But it's 140,634. That's how much it's changed from year. It's gone up. If it's a negative number, make sure you show that it's negative. But we can see from here that short-term investments have increased. All right, so now you want to turn this into a percent. So you take the answer we just got, the 140,634, and you divide by the oldest year. So we're going to be using 2016. So basically 140,634 divided by this 234,000. Okay, got 0.601. So remember, multiply that by 100 because you want to turn it into a percent, or just move the decimal place over 2 places, whatever you're comfortable with. So we got 60.1%. Okay, you should all get the same thing. And we're just going to do this for each line. So same thing with accounts receivable and notes payable. So for accounts receivable, 97,364 minus 101,000. I got negative, so you can do a negative sign, or I just use parentheses, 3636. So 3,636. Take that number and divide it by the 2016 amount. So divide it by 101,000 times it by 100 to put it into a percent. We got negative 3.6%. Okay. And once again, if it's negative, make sure you indicate that it's negative because this is for other people to look at. And if it's decreased from year to year, you want to let them know it's decreased and not increased. So you do have to be specific with that. Notes payable, 0 minus 88,000 is negative 88,000. So negative 88,000. Divide that by the 2016 number. This should be pretty easy. So divide by 88,000 times 100. We get negative 100%. Okay. So it just lets us know, notes payable went down 100%. That's really good, because we don't want there to be debt. So the fact that there's no debt, that's a good sign. Accounts receivable, that's people owing us money, that went down. Does that mean we're not making enough sales, or are we collecting from our customers better? So we have to look into that further. And short-term investments increased by 60%. So that's really good. That might mean that we have more cash. So we're taking the cash that we have and we're investing that. So, I'd say overall, this gives us a pretty good picture on how the company's doing. Obviously, there would be more lines, but this is just to give you an idea. Okay, so that was it for the horizontal analysis. Now we're going to be talking about the vertical analysis. Okay, so this is also very easy to do. We're not going to be comparing information across time, so we really only need 1 year in this case. But think of a vertical line up and down. We're just going to be using 1 year's worth and comparing every number to a base amount. This is also called common size analysis, or vertical analysis. So you'll see both words used interchangeably with each other. Okay, so to find this, you take whatever account we're looking at and you divide it by a base amount. So I'll kind of let you know in a moment what the base amount would be, and then you turn it into a percent by multiplying it by 100. So if we're talking about a balance sheet, the base amount would either be your total assets or your total liabilities, and that should say and equity, because basically your total assets have to equal your liabilities and equity. So whichever number you use, it's going to be the same number. So usually I just look at total assets, or I just go to the bottom line, the liabilities and equity added together. Okay, if we're looking at an income statement, it's going to be your total sales number or your total revenue. It'd be the number at the top. That's going to be your base, and we're just going to take every other number below that and divide it by that base amount. So the purpose is really to see on like a balance sheet, out of all of my assets, how is it broken up? How much of my assets are cash? How much are investments? How much is my land and my buildings and my PP&E? When looking at an income statement, we're going to be looking at sales, your total sales, and where did that all go? To which expenses were the highest? How much did I get to keep as my net income based on what my total sales are? So this is a really good indicator as well as how a company is doing. So we're going to go to the next practice problem. So this is number 2 on the classwork page. Okay, so in this case here, it's going to be an income statement. Okay, so it says income statement here. So remember, the base for an income statement would be your sales or your revenue, whatever they call it. So this here is our base. So put a little star next to it. Basically, we're going to take every single number here and divide it by that base number. So the base is always going to be 100% because it's itself divided by itself. So 100%. So the rest of these we need a calculator. So cost of goods sold, you're just going to take this number divided by the base, the 740,000. So 560,300 divided by 740,000. Remember, multiply that by 100. I got 75 point, and it keeps going, so I'll just do one decimal place. 75.7%. Okay, gross profit, we're going to do 179,700 divided by the base of 740 times 100 to turn into a percent, or just move the decimal place over. Get 24, and I'll round 24.3%. Okay, operating expenses, same thing, 128,200 divided by the base, 740,000, times 100, 17.3%. Okay, and finally, 51,500 divided by 740,000 times 100. Please make sure you're doing this with me, just so that I know that you know how to do the math here. Get 7%. So this lets us know out of all the sales we made, 7% went to our net income. That means we only got to keep 7% of what we made. And you can see where everything went. So basically, most of my sales went to my cost of goods sold, basically getting the product. So depending on what this industry is, that this might be good, this might be bad. It depends based on its competitors. You always want to keep as much of your sales as you possibly can. So with cost of goods sold being so high, maybe we can somehow bring that down by using a different supplier, or getting our goods a different way. So we do want to have higher gross profit and keep a higher net income. Okay, so that's it for the vertical analysis. Just a couple other little pointers to bring up when it comes to the vertical analysis, or the common size analysis that they call it, is you can also make this visually a little bit nicer looking. So here we have the income statement. They're showing it like a pie chart. You know, the whole thing would be 100%. It would be my total sales, and how it's broken up. See, like 50, in this case, 59, almost 60% went to cost of sales. This orange part right here is how much I got to keep as net income. So that's a pretty nice little chunk. And then where all of my other money went. Here it is by looking at the assets. So the whole thing, so this is just like another way they can represent it. I'm not going to make you do any visual graphics or anything, but this is just information we'll show you. Out of all of my assets, it's broken up into different colors on where everything went. So as you can see, the biggest chunk of my assets is right here, this orange, right? Long-term marketable securities, 56%. So of all of the assets I have, 56% are in long-term securities. Is this good? Is it bad? Usually it's pretty good, because it's saying that, you know, a lot of our money is in the stock market. We have a lot of cash for us to do that, and hopefully we're earning money on it. Now, in an environment like what's going on now with the coronavirus and the stock market crashing, you know, this might not be such a good idea to have half your assets actually invest in the stock market, because a lot of it's gone down a lot. So that might actually hurt a company in this case. Okay, now the last main topic we're going to be going over is the ratio analysis. The ratio analysis is going to be probably the more difficult part of this chapter, because there's a lot of formulas for us to go over. So this is where the building blocks from earlier comes into play. We have the liquidity and efficiency ratios, and I'll be going over all of these separately coming up. So we have, you know, current ratio, asset test ratio, accounts receivable turnover, total asset turnover, days sales and inventory, days sales uncollected, and inventory turnover. So there's a lot of formulas here. Solvency, not as many. So the solvency ratios are the debt to equity ratio and times interest earned. We have the profitability ratios, profit margin, return on common stockholders' equity, and return on total assets. And then market prospects, earnings per share, price to earnings ratio, and dividend yield. So like I said, we're going to be going over all of these separately. So first we'll be going over the liquidity and efficiency ratios. Okay, so the first one we have is the current ratio. And by the way, liquidity and efficiency ratios are how easily can the company turn what it has into cash? Are they taking our cash and using it efficiently? Okay, so for the current ratio, it measures the short-term debt-paying ability of a company. A higher current ratio suggests a strong liquidity position. So for this one here, we want a higher number. The higher, the better. Basically, can our current assets cover our current debt, our current liabilities? And we definitely want it to. We want at least an answer here of 1, because we do want our assets to cover our liabilities, but like I said, the higher number, the better. So when we do this formula here, we want to make sure we take just the current assets. So this is a common mistake. It's not all of your assets, just the current ones. Divide by just your current liabilities. So the better you are at understanding the balance sheet here, the better you'll be able to do this by being able to figure out which ones are current and which ones are not current, the long-term ones. So you do have to separate that out. Next, we have the asset test ratio. This is a really strange name for it. It's also called quick ratio. So it's very similar to the current ratio, but basically we just take a few things out of it. Analysts say that um, some of our current assets we do need or it can turn into cash as quickly as some other things like inventory. Maybe we can't sell it as quick. So we want a much quicker ratio here. So we just take our cash plus our short-term investments plus the current receivables. So it's not all of our current assets, not like we won't include our inventory or prepaid expenses, but we will be taking a lot of our assets here, current assets, just not all of them. And we're just going to divide by current liabilities, so it'd be the same thing you had for the current ratio. You would use that same number here for current liabilities. Okay, and then we have the total asset turnover. So as it states here, reflects a company's ability to use its assets to generate sales as an important indication of operating efficiency. So once again, we want a higher number, and same thing with the asset test ratio, a higher number the better. So total asset turnover, it would be net sales, so your sales divided by your average total assets. So we're doing an average here, so don't just look at what our total assets are. You're going to look at your total assets from this year, last year, add them together and divide by 2. So it's really important when you see average here that you have to calculate the average from last year to this year. Okay, we're going to go over some more of these liquidity and efficiency ratios. So we have accounts receivable turnover. Measures how many times a company converts its receivables into cash each year. We do want a higher number. We want it to turn over as many times as we can, which means that we're making sales and we're collecting the money. We want to keep doing that many times throughout the year. So to do this, we want net sales divided by average accounts receivable. Remember, here's that word average again. We're going to take our accounts receivable from this year and last year, add them up, and then divide by 2. Next, we have days sales uncollected. So it's really similar to the accounts receivable turnover. It's almost like backwards a little bit. This is how many days that we have an account on our books. Somebody owes us money before we collect it. So it's the average amount of days that someone owes us money. And in this case, we want a lower number. I mean, ideally, we want somebody to owe us money for maybe 1 day and then pay us. If it's over maybe 60 days, there's a problem. We're not collecting money in time. If people owe us money and they're supposed to pay us within 30 days, then we always want this number to be under 30. So to do this, we do our net accounts receivable, divide by our net sales, times 365. Okay, next we have the inventory turnover. Similar to the accounts receivable turnover, it's how many times a year our inventory turns over, so that we buy the inventory, we sell it, and replace it throughout the year. We want a higher number here. We want it to turn over as many times. We want to buy inventory, sell it, do it again. Buy inventory, sell it, and we want to keep going through this same system. So you would be doing cost of goods sold divided by average inventory. Remember, it's the average. So we take inventory from last year, this year, add it together, and divide by 2. Okay, days sales and inventory is similar to days sales uncollected here. So it's how many days we have our inventory for before we sell it. We want a lower number because ideally we only want our inventory for as short amount of time as possible before we end up selling it. Now this would be different depending on what industry we're in. So for instance, a restaurant that has fresh food, they might want a much lower number, like maybe under 7 days before they end up selling it. A company that, like a car dealership, it might take them 60, 90 days to sell a car, so they'd have a much higher number. So it really depends on the industry here. But you would be taking your ending inventory, so basically this year's inventory, divide by your cost of goods sold, times 365. Okay, so now we're going to start talking about the solvency ratios. So solvency really means the survivability of a company. Can they survive over time? Are they solvent? Are they going to be able to pay a lot of their debt? So first we have the debt to equity ratio. and measures what portion of a company's assets are contributed by creditors. A larger debt to equity ratio implies less opportunity to expand. So in this case, we do want a lower number. This one's pretty easy. It's just your total liabilities over your total equity. Okay, times interest earned. This is the most common measure of the ability of a company's operations to provide protection to long-term creditors. So basically, out of the income we're making, can we pay our interest expense? Because we do owe that to the people we borrowed money from. So can we pay our interest? And we want a higher number here. We want to be able to pay our interest many, many times. Definitely something higher than one we want to get, and the higher the better. This one here is a little harder to do. It's income before interest and taxes. So basically it's our income, our net income, and we want to add back our interest expense and our tax expense. So our income right now already has interest and taxes taken out of it. So that's why we want to add it back in. And then you would just divide by your interest expense. Okay, we have the profitability ratio. So these are basically how profitable a company is doing. Lets us know, if we're doing well with our sales and with our income. So the first one is profit margin, describes a company's ability to earn net income from each sales of dollar. So basically here, it's really easy. It's your net income divided by your net sales. So basically out of all the sales I made, what percentage of that will go to my net income? Like, what do I get to keep after I pay all my expenses? So we definitely want a higher number here for profit margin. The higher, the better. Ideally, we want to make sales and keep all of it, but we can't do that. We do have to pay salaries, maybe office space. So a lot of our money does need to go somewhere, but we want to keep as much of that as we can. Okay, return on total assets measures how well assets have been employed by the company's management. Or are we using our assets effectively? Are we taking our assets and using them to make income off of? Just like OCC's asset of the Gateway building, are we making money off of it? Yes, because there's classes there. So this kind of just lets us know if we are using our assets wisely, and we do want a higher number here. Okay, and this one's pretty easy. Net income divided by average total assets. So I'm going to look at my total assets from last year, total assets from this year, add them together, divide by 2, because remember we're doing the average. Okay, return on common stockholders' equity. This one here is a little bit more difficult as well. It indicates how well a company employed the stockholders' equity to earn net income. So kind of similar to return on total assets. Are we earning income from our assets here? Are we earning income from, issuing stock? So we have net income minus preferred dividends. If a company does not have any preferred stock or preferred dividends, you just wouldn't do anything. It would just be net income divided by average common stockholders' equity. So we have to look at stockholders' equity section, which would be the common stock, the retained earnings. We look at that we add that together for 1 year. We do the same thing for the year before. We find the average by adding them together and dividing by 2. Okay, so next we have market prospects. So this is really how well companies are doing in the stock market. So first we have earnings per share. This is a pretty important indicator of how a company is doing. A lot of people in finance really like to know what the earnings per share is. They also call it EPS. So it's the portion of the company's distributable profit allocated to each outstanding share. A very good indicator of the profitability of any organization, and is one of the most widely used measures of profitability. Like I said, it's a very important number. We want the higher, the better. A lot of people in finance won't invest in a company unless earnings per share is over a certain dollar amount. So this is definitely one of the more important formulas that we're going to be doing. So the numerator is really similar to the last one we did, net income minus preferred dividends. Remember, if there are no preferred dividends or preferred stock, you would just not do anything here. Divided by the weighted average common shares outstanding. And I'm just going to give you that number because that's more of a finance thing on how to figure out the weighted average shares outstanding. So I'll just tell you what the shares outstanding are, and you would just use that. but you would get a dollar amount here for earnings per share. So, $2, $5, you do want something in the positive though. Okay, price to earnings ratio, often used by investors as a general guideline in gauging stock values. Generally, the higher the price to earnings ratio, the more opportunity a company has for growth. So you want a higher number here. You would take the market price per common share, so whatever the stock is going for in the market, and divide it by earnings per share, the EPS. So you do have to do earnings per share before you do the price to earnings ratio. Okay, and then dividend yield, this is something we've gone over before. You had to turn in what the dividend yield is for the first part of your stock market project. It's just basically for every dollar invested, what percent do I get back as a dividend as an investor? So personally, like I like to invest with a high dividend yield, something over 4% usually. So if I have $100 invested in the stock market and it's a 4% yield, I'll know I'll be getting $4 back on that. Some of them go higher, some of them don't give dividends at all. So some of yours, your dividend yield was actually zero because there's a lot of companies that don't, issue dividends at all. But you would divide your annual cash dividend per share, divide by your market price per share. So it's pretty easy to do. Okay, so now we're going to be working on the practice problems. So this is the third and last one on your handout. So we're going to be doing this together. So if you could just follow along, that would be really helpful. So then you can kind of gauge really if you are understanding how to do this and you're able to use a calculator correctly. So when doing these problems, you might want to have the Note 17 page open because all of the formulas are right here for you. So for instance, the first one is the current ratio. So current ratio is current assets divided by current liabilities. So when you're looking on here, you want to find just your current assets and your current liabilities. You don't want to look at all your total assets. And remember, it goes in order. So all the current ones are at the top. So we've got cash, short-term investments, accounts receivable, merchandise inventory, prepaid expenses. Those are all current. Once it gets down to plant assets, that's something that's long-term. So we want to take just the current ones. So remember the ones that we're going to be using up within the year. And we're going to add this together. And then you want to divide by your current liabilities. So we're going to go to our liabilities section. And remember, it also goes in order. So we have accounts payable, accrued wages payable, that's all current. Income taxes payable, that's current. And then look, it gets into long term, so no. So it would just be these first three. So if you got your calculator, you can add this up. So add up your current assets. So 10,000 plus 8,400 plus 33,700 plus 32,150 plus 2,650. So I got 86,900 for my current assets. Then I'm going to add up my current liabilities. 17,500 plus 3,200 plus 3,300. I got 24,000. So we're going to divide that. So we got 86,900 divided by 24,000. So make sure you kind of do the math so that you're getting the same numbers. And I got 3.6. And how we're going to label this is 2:1, like a ratio. 3.6, and you're going to do 2:1, and that's always going to be 2:1. You're not going to use anything else there. Okay, so that's how we do the current ratio. Next up is the acid test ratio, which is very similar. So we're not going to be using all of the current assets. So we're going to be using cash plus short-term investments plus the accounts receivable. But we're not going to be using merchandise inventory or the prepaid expenses. So instead of adding all 5 up, we're only going to add these 3 up. Divided by same thing, your current liabilities. So that's same 24,000. So we're going to add up 10,000 plus 8,400 plus 33,700. We got 52,100. Divide by the 24,000. We already got that. So we should be getting, if you're following along, 2.2 to 1 when you do the division. Next, we have days sales uncollected. Sales uncollected is accounts receivable. Divide by your sales times 365. Okay, so let's go back. We want to find our accounts receivable. Let me clear this off. Okay, so accounts receivable, right? Divided by net sales. So here's your sales times 365. So we have 33,700 divided by my sales, 448,600 times 365. So I'm just going to round. I got 27.4. So day sales uncollected would be 27.4, and it's days, so it's labeled days here. So the next one for D is inventory turnover. Cost of goods sold divided by average inventory. So we're going to do the average here. So let's go back. We need to do cost of goods sold. Cost of goods sold right here on the income statement divided by average inventory. So here's my inventory from this year. We need last year, so that's here in this additional information. So when you read through this, inventory was from last year 48,900. Okay, so to do this, you would do cost of goods sold 297,250 divided by the average of these two numbers here. So to find the average, do 48,900 plus 32,150. Remember, divide by 2. You want a number right in the middle of it. So I got 40,525 as my average inventory. So to find this, I would do cost of goods sold 297,250 divided by this average 40,525. And I got 7.3. We'll just do one decimal place. So for part D, it's 7.3 times. 7.3 times. Because it's how many times your inventory turns over throughout the year. 7 times doesn't seem too great. Remember, we want a higher number, but then again, we don't know the industry. So next we have days sales and inventory. This formula is ending inventory divided by your cost of goods sold times 365. So ending inventory, which is really this year's inventory, divided by cost of goods sold times 365. So we have, let's see, ending inventory, which would be this 32,150 divided by cost of goods sold, 297,250 times 365. So let's do that in a calculator. 32,150 divided by the 297,250 times 365. I got 39.5 days. So that would be your days sales and inventory, 39.5 days. I mean, that's a lot. That means they have their inventory for over a month before they sell it. Maybe it's okay. Maybe it's a furniture store or a car dealership. But if it was a restaurant, I'd say that's probably a little too high. Next, we have debt to equity ratio. This one's pretty easy. It's just your total liabilities, which is your debt, divided by your total equity. Okay, so we're going to go to the liabilities and equity section and basically split it up. So part of this is our liabilities, the top part, and then the bottom part is going to be our equity. So basically, here is where it stops. See the payables? That's our liabilities, anything with a payable. And then the other items are stock, and our retained earnings is our equity. So we have our total liabilities divided by our total equity. So you'd have to add these up and add up your equity and then divide. So let's do that. 17,500 plus 3,200 plus 3,300 plus 63,400. I got 87,400 for my total liabilities. Now we're going to add up our total equity. 90,000 plus 62,800. We got 152,800. So we're going to divide those two numbers, 87,400 divided by 152,800. Okay, we got 0.57. So that's going to be our answer. 0.57. And then we're just going to label this to 1. 0.557. And remember, the lower number the better, so that seems pretty good right there. Okay, so next we're going to do times interest earned. This formula is income before interest and taxes. So remember, we have to add back our interest and tax expense divided by our interest expense. Okay, so let's go to the income statement. So it's basically our income adding back our income taxes and our interest expense. Another way to do this is if you look, it already has income before taxes. We want to know what our income is before taxes and interest. So you can also just take this 48,650 and then add the 41 to it. It's like kind of like a shortcut. Or you can take your net income, add back your taxes, add back your interest. So it's just up to you. You get the same answer. We're going to add these numbers together and then divide by our interest expense. So we're going to add 48,650 plus the 4,100. I got 52,750. Divide by the 4,100. I got 12.9, so it'd be 12.9 times as the answer for that. Because it's times interest earned, 12.9 times. That means we can make our interest payments almost 13 times over, which is really, it's good. We wanted to, higher the better. Next up, we have profit margin. The formula for profit margin is net income divided by net sales. So on here, we want to find our net income, which is on the income statement, divided by net sales. So this one's pretty easy. We're going to do 29,052 divided by 448,600. All right, so it's 0.06. You want to turn this one into a percent. So if you want, you can multiply by 100 or just move the decimal place over. So it ends up being 6.5%. So profit margin is 6.5%. So out of all the income we make, we can keep 6.5% of that as income, out of all the sales we make. Okay, next we have total asset turnover. This formula is net sales divided by average total assets. So net sales divided by average total assets. Okay, so we have the sales here divided by the total assets average from this year and last year. So this year it's 240,200, and I want to find what my assets were last year. So we can find that up here. Total assets right here, 189,400. So I want to find the average between these two numbers, the 189,400 and the 240,200. So we're going to add them together. Add them together and then divide by 2. So you should get 214,800. So that's my average total assets. So I would do my sales, the 448,600, divided by the 214,800. And it is 2.1 is the answer. So total asset turnover 2.1 times. Next, we have return on total assets. For that is net income divided by average total assets. So we can use the same denominator that we used before because it's still average total assets, but the numerator changes. So it's net income instead of net sales. So we can still use the 214,800, but instead of sales, we're going to use net income. So it's going to be 29,052 divided by the 214,800. So 29,052 divided by 214,800. And once again, we're going to put this into a percent, so you can multiply by 100 if you want. We got 13.5%. Okay, last up we have return on common stockholders' equity. Formula is net income minus preferred dividends divided by average common stockholders' equity. So I'd say this is one of the trickier ones to do. So let's take a look. Let me clear off the pen. Okay, so we want to take net income minus preferred dividends, but if you look, we only have common stock. So it's really just net income divided by average common stockholders' equity. So remember, the equity section is over here, liabilities and equity, but we're not going to include the liabilities, so it's what's ever left. So here's my equity from this year. So I'm going to add that up and we get 152,800. But I want my average common stockholders' equity. So that means I have to do this for this year and for last year. So I have to look at last year. Common stock was 90,000 and retained earnings is 22,748. So we're going to add those together as well. 90 plus 22,748. We get 112,748. So this involves an extra step. Takes a little bit longer to do. So I have my equity section from last year. I have my equity section from this year. I want to find the average. So we're going to add them together and divide by 2 to find the average. And I got 132,774. So that would be my average common stockholders' equity. So I'm going to take my net income and divide it by the 132. So 29,052 divided by the 132,774. Turn that into a percent, so multiply by 100. Got 21.9. So we have 21.9%. Okay, so I hope you're able to follow along with that. So this concludes the Chapter 17 PowerPoint. I hope it was helpful and informative. If you have any questions or comments, please let me know. Thank you.